we're recording. We're good. You're good. Thank you, Ken. Appreciate it.
Good, good. Yeah, I am.
We're gonna really try to use it. Wow!
And get this meeting back. I hate to be interrupting everybody, but we gotta get the show on the road. So please, let's all come back now. What's going on?
How you doing, Dave?
Are you the cameraman now?
Okay,
Thank you.
Great networking.
Started last year's, but I tried in the past saying, well, it didn't work. So we're good to go. Everybody's networking like they're supposed to be doing. You guys are just, your energy level is way up, and that's wonderful. You're not wasting a moment, so I'm glad to see that. We have got Craig Lieberman is going to be here. He's the founder, CEO of Apartment Specialists. Investment Specialists. Thank you. Okay. One of the most influential commercial brokerage in Santa Barbara. Craig has been a leading commercial real estate broker, counselor, consultant along California's Central Coast for more than 30 years.
I'm only 21, but
Prior to forming the Apartment Specialist, Craig was the #1 real estate producer for one of the top region's brokerage companies. While there, he received the company's National Chairman Award, one of the most prestigious awards given to top performing sales agents in the nation. His personal experience, knowledge, and understanding of commercial real estate market is unmatched on Central Coast, including undergraduate and graduate degrees in real estate appraisal and investment analysis. Excellent. Right. He and his team have helped hundreds of investors to realize their dreams and achieve their financial goals. So I want to welcome Craig here. Thank you very much for being willing to speak with I'm sure, I think Linda's got some special maybe questions and answers that we're going to do here.
by the way, before we start,
Sure.
in line with Matt's no pain, no gain philosophy, I want everybody up. We're going to do push-ups and sit-ups.
Oh, yeah. Okay. Okay, you got it?
Great. Yeah.
Black out that screen.
Now we're going to talk about multifamily properties, and I love multifamily properties. I've purchased 24 units in 5 states. My family back in Los Angeles, they have a lot of apartment buildings in the Montebello, Whittier area. I myself have a multifamily unit in Hawthorne. It's a great cash flow, and I just love apartments. I think they're awesome. Pedro, can you talk a little bit about your experience
Sure.
and how you helped Craig out?
Yeah, absolutely. So let me just quickly introduce myself. I'm Craig's business partner, an apartment investment specialist. My name is Pedro Vasquez. My picture is on the brochure. So I am a credible source. And we also do property management as well. I'd like to just give you a quick overview. We're a little bit unconventional in terms of not having a PowerPoint, that sort of thing. Just because, at least in my mind, I feel that most of you guys come here to learn about what the different vendors do, and I always like a panel discussion. And I kind of want to open it up to any questions that you guys may have, so that you in turn can grasp most of the information. It's not just us talking about what we do. So I'd like to at least do 5 things. First thing is I'd like to introduce myself and Craig and what we do, give you guys a pretty good idea of our backgrounds. Second thing is I want to talk about what our company does, the products and services that we provide to clients. Third thing is I'd like for Linda to maybe ask some questions of Craig and what we do to give you guys an overall idea. Lastly, or fourth, is I want to open it up to whatever questions you guys may have. And at the end, maybe we'll just conclude and make sure everyone has a pretty good idea of multifamily investment properties.
Then we'll do those push-ups and sit-ups.
So I'll let Craig introduce himself and talk about his education and experience.
Oh. Thank you. Nice seeing all the faces out there. My name is Craig Lieberman. I'm the broker, founding managing director of Apartment Investment Specialists. We represent buyers and sellers of apartment sales transactions. We also do third-party property management. The reason we got into that is because I own property and I was managing my own stuff. Why not manage it for others? Talk about education. It's hard to talk about myself, but my background goes back to when I was a young guy. I worked on the Trans-Alaskan Pipeline as a laborer, and we were making a lot of money at the time in the 70s and 80s. And my tax guy says, you need to buy some real estate, or you're going to get hammered with taxes. So my first property, I went together with my brother and a friend, and we bought a 5-plex in Costa Mesa. And we made money right off the bat. I was 21 years old. I found, and we kept exchanging from there. I found I liked real estate, so I actually went and got an undergrad degree from San Diego State in business administration with an emphasis in finance and real estate, and ultimately went and got a master's of science degree in real estate appraisal and investment analysis from University of Wisconsin-Madison, one of the best premier graduate programs in real estate. I have subsequently gotten a CCIM designation, which stands for Certified Commercial Investment Member, and it's a pretty disciplined year-long training where you go into financial analysis, market analysis, lease analysis, and those kind of things. So,
That's good. So learned a little bit about Craig, and my history is just a tad bit shorter than his.
he's older than me too.
I'm 10 years his senior. But I guess my education starts from Cal Poly San Luis Obispo. How many of you guys know where that school is? Oh, did you? So I graduated December of 2004 from Cal Poly San Luis Obispo with a degree in business, and wasn't really sure what I wanted to do with my life. I thought I wanted to go to law school. So there I go, interviewing a few attorneys, and I realized that in order to be a good attorney, you got to eat, sleep, and drink law. You really have to love it or not do it to be successful.
And you have to like to argue.
Yeah, and I'm a bit more timid than that. So I interviewed a few attorneys, and I said, well, how do I get in the door? And I started hearing these stories. And one thing I've realized about attorneys is two things, and I hope I don't offend any attorneys in the room, if there are some. But number one, you have to argue a lot. You've got to have high energy to do that. Secondly, a lot of them did it for the status. They did it to make a lot of money, and maybe they weren't completely passionate about the law, but nevertheless was a means to make good money. One of the things that I found in common with most attorneys, if not all, is they all own passive income, real estate specifically. So then I started diving into that area, and I thought maybe a career in commercial real estate would kind of suffice my need to want to be successful and also fulfill my passion. So I started diving into that. I took a 6-month internship with a real estate development company in the San Fernando Valley, and I think I got the bulk of my corporate real estate experience working for a company called SCI Real Estate Investments. They were based out of Santa Monica. Anybody heard the name? No? Yeah, they were the second largest tenant in common sponsor in the country back in the heyday of real estate, 2005-06. Since then, I just recently took a course at USC for real estate development. Graduate level course, and that's taught me a lot about redevelopment, particularly in urban areas, and how important public transportation is to real estate values. So I really, really appreciate the education you get from real estate, because everyone deals with real estate, whether you want to admit it or not. Everyone's affected by real estate on a day-to-day basis. So that's a little bit about my education. I moved up to the Santa Barbara area about 1.5 years ago, and I've been working with Craig since. simply because I love the Central Coast. It's a beautiful, beautiful place.
He likes his wine too.
And I do like my wine. So that's a little bit about me. I guess we can both talk about our company. Sure.
I'll let you.
After I take a sip. So what Apartment Investment Specialist, what we do, we are a boutique firm located here in Santa Barbara, and
Right at Mission State. If you're familiar with that.
what we do is primarily represent buyers and sellers of apartment sales transactions, and we also do third-party property management, as Craig mentioned before. You guys were passed out a brochure, which is a mailer that we sent out to all apartment owners in the Tri-County areas, and that's from San Luis Obispo, Santa Barbara, Ventura, and it also carried over into North Los Angeles.
Yeah, San Fernando Valley, Burbank, Glendale, Pasadena.
So as opposed to just a general commercial real estate firm, we focus on apartment sales because we like to stick to what we're good at. You know, we're a specialist in that field. So that's a little bit about our company. And then Linda, would you like to introduce some questions?
Yes. I came up with some questions for them, and I think the audience will appreciate the answers that we get. First of all, Craig, Pedro, I want to know what's going on in the commercial sector right now, specifically in the Central Coast and the Southern California market.
Well, first of all, I want to address the fact that when Linda talks about commercial, apartments are one, as CCIM, which only deals with commercial, how they define commercial properties is office, industrial, retail, lodging, and multifamily. So our concentration is multifamily or apartment. So that's what we'll be addressing in this discourse. So you're asking what kind of trends?
Yeah.
That's a big question, but I guess what I'm going to say in general is that apartments, compared to those other commercial sectors, is the darling investment right now. Reason being, we're in a economic recession right now. What's gotten particularly hard hit is the office and retail sector. Office because you have 12, I don't know what the unemployment is right now. It was nationwide about 9%. Ventura County, I know, is about 12%. I think Santa Barbara County is about 10, something like that. Well, you have less need for as many office workers. So because of that, you're getting less need for space. That's why you see a lot of subleasing by companies, etc., because they just don't need that much space and they're overpaying for the rental or lease portion of their company. Retail, we're becoming much more involved with the internet. People are buying on the internet, less need for bricks and mortar. And because of the economic paradigm we're in, there's less consumer confidence and therefore less consumer spending. So those guys have been particularly hard hit. And another thing I'm going to be talking about is the fact that mortgages for apartments are sweet. And I'm going to explain that. And there's several entities that will lend on apartment properties that don't lend on the other commercial sectors. And you need fluidity in mortgage lending, or as we've seen in the housing sector, it just dries up. So
another thing I think it's important to mention, as someone alluded to earlier, is we're becoming more and more of a renter nation. And maybe you can talk about
yeah. In 2004, at the peak, we were 70% homeowners in the nation. We're now about 65. We're probably trending towards, could be, they say 63, 62%. Well, if you figure how many households per percent, that's a lot of need for rental housing. And I'm just going to, I wrote myself some notes to talk about the specifics in why we're getting such a strong demand, underlying demand for apartments by users. First of all, Generation X and Ys, the millennials, they're the biggest users of apartments. And first thing, because of this economic situation we're in, they want to be more fluid. They're the ones coming out of college. They're the biggest users. They want to be more fluid and more of a free agent in seeking that job that's so hard to get. The last thing they want is a house to have to sell. So they're staying very flexible by being renters. So that's the number one reason. But also for economic reasons, this age cohort is forming households later in life, having babies, children later in life. So chances are they're going to be renters more so than homeowners. Another economic reason, we have some mortgage brokers here in the room. Those people are socked away with, or 1/3 of these of the college graduates are stuck with school loans. That makes them not being underwritable for mortgage loans, so that makes them more prone to be renters. The bottom line is, from all the 3 age cohorts that I'm going to be talking about, they all have lost the allure of home ownership. We just, you know, when we were baby boomers, not you, when we were baby boomers, the thing we were supposed to do is get married, buy a house, that's your nest egg. When you retire, well, we've seen that's not some paradigm we can counter. Well, these Generation X and Yers, the sons and daughters of the baby boomers, they've seen what's happened to their parents' houses. And for that reason, they want to be more nimble. The baby boomers themselves, a lot of them lost their houses, and it's an unfortunate thing. They're stuck being renters, if you will. And then even the retirees that might be empty nesters, maybe even have tons of equity in their property. They don't want the maintenance issues. They don't want, if they still have a mortgage, to have to be paying that. They want to travel. So for that reason, they want to be more of a renter nation. Also with that, so what that does is that gives a drive, a strong demand for this product called apartment units. On the supply side, at least along the coast here, inland, it's a different story, maybe a little bit, but on the coastal range, there's hardly any new supply being built. So what do you get when you have strong demand, no supply? That's a formula for price escalation. And what you're getting, first you have to get the occupancy rates before rents go up. Occupancy rates have to reach a certain threshold, usually at 95, 96%. Once it reaches that threshold, all you see is rental rates starting to rise. The other part that the other commercial sectors don't get the benefit of is the mortgage rates. Fannie Mae, Freddie Mac, a lot of people don't know this, they lend directly. You know, normally they're making the secondary market for mortgages more fluid. In this case, they haven't been so profitable in that because of the foreclosure situation. But in apartments, that division of Fannie Mae, Freddie Mac, they've done exceptionally well. That's a very strong market. Well, to give you an example of what you can do, people think commercial mortgages. On a 5-year fixed, you can get 3.45%. Well, if your rents are rising like this every year, and they will be for the foreseeable future, if your rents are rising and your biggest cost of ownership, which is your debt load, is going down, what does that do to your bottom line? Your net operating income is just going to increase. So I'm going to make note here that you can probably count on about, give or take, what we see Santa Barbara, you're probably talking about a 3% cash on cash. The Ventura County area is probably more like a 5 to 6%. But you're buying, when you buy an apartment property or any property, you're buying 3 components of return. You've got your cash flow from operation, you've got your cash flow from reversion, and to a lesser extent, your benefits from taxes. So if your cash flow is giving you a 5% rate of return, is much better than your treasuries would give you if you put your money in those or savings account. But on top of that, very likely, because as rents rise, all things being equal, your value is going to rise. So if you're holding on to property over a 3-5 year period, these aren't flippers necessarily, but if you're steady Eddie about it, you know, you hold it for a certain amount of time, you're going to see not only your cash flows going up, but because of that, you're going to see your values go up.
And if I could just sort of summarize what Craig has said and also chime in on a few things. The first thing I will chime in on is this is our first time really going out to this type of audience, and I have realized that what we offer is a different product type than what you're expected to. Most people, I think, in this room are very familiar with residential flips and holds and that sort of thing, whereas multifamily properties, it's a whole different, you know, ballpark or ball game, or it's a whole different paradigm of thinking. So there's going to be some things that are different, maybe not as high cash-on-cash return, but there's different components to the benefit, tax benefits of owning multifamily. When he was asked earlier why apartments are the darling investment, we cited several examples. I'll just reiterate 3. The first one is the generation X and Y and supply and demand, their need for apartments and why apartment trends are going to continue to increase. The second thing is financing. Financing is a lot easier to obtain through apartments than it is through any other commercial asset. I think the number is anywhere from 80 to 90% of commercial financing.
85% of apartments, at least the bigger apartments, because that's what Fannie and Freddie mostly do, but you've got also FHA in there. Between HUD, FHA, Fannie, and Freddie, I think they lend probably about 85% of the apartments, to a much lesser extent the insurance companies, and then a few other lenders.
And aren't you qualifying on the cap rate as opposed to your, you know, your loan, what you personally
Yes.
can qualify for?
Here's if I can address that. One of the things that you may want to hone in on if you want a quick value add on buying properties is the 2 to 4 unit sector. Reason being, those are loaned or underwritten the same way as houses, income and credit, okay? And you saw a lot of subprime loans, etc. That sector imploded to the tune of between 30 and 50% reduction in value. So what you see is what you get. You're not going to see any more decrease in value, at least around here. It can only do better over time. So yes, that's the way those are loaned in the 2 to 4s. In the 5+ units, they take your net operating income, which is your revenue minus your expenses, and they put that as the numerator over the denominator, which is your annual debt service. The lenders want a minimum of about 15% buffer, or 1.15 times the annual debt service, in case your rents go down, your vacancies go up, your expenses go up. They just want that as, that's how they underwrite it, as their risk adjusted underwriting. And so those properties didn't get hurt like the 2 to 4s because they were underwritten that way. So for those that may have questionable credit or what have you, they'll still take that into account, the 5+ lenders, but they won't put as much emphasis on that vis-a-vis the 2 to 4 units.
And what about the amount of apartments you can have compared to loans on homes? There's like 4 to 10 or whatever.
Yes.
I imagine commercial is unlimited.
Yeah, I mean, they don't have that Fannie Freddie rule. They might, if Fannie or Freddie was lending on the apartments, I don't know if they would, but most people don't own, 10, 12, 15 apartments to worry about it. I don't know if that's an issue.
Does anybody have any questions yet?
Yes, I buy a 5-unit or more complex. I don't want to manage it. What are the typical management fees?
Where is it? And then I can tell you.
Say it's in Lompoc.
In Lompoc, okay, we're going to charge you double.
We actually manage a 9-unit that he's a part of.
I own a 9-unit and a 12-unit out there, and we charge 5% on that. So,
But we knock on a few doors every month.
yeah. That when Mac talked about not investing in the hood,
You met it?
well, they call Lompoc Lompton sometimes, but that's another story. But no, let me tell you, we have to go out and bug tenants sometimes to get our rent. So
That's the reason I've never gone for that market sector, because I went out and looked at before I bought my residential buildings,
Yeah.
and frankly, as a woman, I wouldn't go into those.
yeah, well, that's why you need guys like us to do your property management.
By the way, he's the one that carries the bat. I just did.
No, I'll listen to these people, but you get a quick, being 58 years old, you get a quick learn on whether these guys are BSing you or they really are having a hard time. But ultimately, it's a business like anything, and you've got to pay the mortgage and ultimately the partners. So.
At the time I was looking at them, which was about 5 years ago, this was in Colorado, they were all built in the 60s and 70s, and those people were not making much money on them.
The what now?
The owners were not making much money on them. They were
Depends on the deal. It really depends on the deal. Most apartments were built in the 50s, 60s, and 70s because after the World War II, people coming out, the developers found that's where the influx of traffic was going. They were building a lot of houses and they were building a lot of apartments because there was a lot of land available. Now there's not. But your particular situation about those owners not making it just because they're built in the 60s and 70s, it just really depends on the deal.
It depends, yeah, it depends on the part of the country.
Well, it depends on the part of the country, but you have to know how to buy, like any of these guys would tell you, you have to know how to buy for that particular market.
Any other questions pertaining to this?
What's the typical terms of financing, like a $3 million apartment transaction?
Well, they won't lend you any more than 75% loan to value.
Even if the 1.15 is there?
They, on average, they won't. Especially Fannie, Freddie, and actually, no. I was going to say 85% is what HUD used to do on non-owner occupied, but now they're 75%.
Purchase price, not the appraised, not the market value.
Well, the lesser of appraisal or purchase price.
Yeah.
You have a question?
What kind of multiples are in Santa Barbara for like 15, 20 unit buildings?
Okay, talking about multiples, what he's talking about is gross rent multiplier. We look at values different ways. We look at it, based on how many times, and that's a quick and dirty as opposed to capitalization rate. Gross rent multiplier, you look at how many times is the gross rents, is the sales price. You look in the market, how many times has the gross rents been multiplied to get to the sales price, and you look at a bunch of them over time. Historically, you look at houses, what they sell for. If you see everyone selling for this much, then pretty much that's the going rate. Well, in our market, if we see everyone going for 12 times gross or what have you, well, that's probably where it's likely going to end. To answer your question on duplex, well, in this market, you're going to have higher gross rent multipliers that sellers could expect and that buyers need to expect to pay. Duplexes are going to have your highest gross rent multiplier because they almost act like homes. And depending where it's at, you might have, what are we saying, 15 to 20?
Which is a pretty high multiple. Sorry to interrupt, but I'll just explain. In apartments, we primarily look at three value benchmarks, if you will. There are three indications of how the deal pencils out. The first one is price per unit, so it's a real simple math calculation.
Real quick and dirty.
You take a property that's worth, say, $3 million, and just for easy math, there's 3 units. So, each unit is $1 million, right? Real simple. The second equation is the gross rent multiplier, which Craig talked about, which is basically you take your annual rents and you take that number and you compare it to the sales price. So, for example, in Santa Barbara, you might get a 10 times gross property versus in Lompoc, which is a treasury market, you might get a 10 times.
12.
Or 12. 12
Or
GRM.
excuse me, 8 times.
Or, yes. So the point being is a lower gross rent multiplier means that there's higher risk. And a higher gross rent multiplier means that there's less of a risk. It's almost the inverse relationship when you looked at capitalization rates or a cap rate, which is the third indication, because you want to buy at a high cap rate and sell at a lower cap rate. So when you're looking at capitalization rates, what you really want is a high cap. When you're looking at a gross rent multiplier, what you really want is a low GRM, if that makes sense.
If I could just generalize, it's a risk-adjusted rate of return, both gross rent multipliers and cap rates. So, the more the perceived risk is, based on location, based on this, the lower the gross rent multiplier you as a buyer is going to pay, and the higher the cap rate you're going to want, because the cap rate's really, again, risk-adjusted rate of return. So it's the kind of return you would want to buy that property. To answer your question, 2 units, probably 15 to 20.
15 to 20 units.
So, okay, I was going to say, it's like a gradation. 4 units are going to be, maybe more towards like 12. When you start getting into 15 and 20, depending where it's at, it might be 10 to 12. Okay, and then cap rates. Now here's the problem about cap rates. Not everybody reports, especially brokers sometimes. Everybody reports expenses accurately, and they don't look at it the same way. So it's the larger properties, it's more appropriate to use cap rates because you have more sophisticated investors, more sophisticated brokers. They'll probably report expenses, etc., appropriately. But on 2 to 4 units, I don't like using cap rates because both buyers and sellers and brokers aren't, you have a lot of residential brokers who won't report expenses appropriately, so you really can't, lay your hat on that figure.
And just to chime in for a minute, it's really important when you are looking at apartments to deal with someone that really knows what they're doing, whatever commercial asset you're looking at. For example, we're in a second counter on a 34-unit building in the city of Oxnard, and we've been going back and forth with a broker out of Los Angeles on this property, and they were reporting an NOI of $230,000 a year.
34.
234. He's very specific about that. I hate that about him, and I love that about him. He's got a really sharp memory. So, we went back and forth with our buyer that we're representing, and he says, Pedro and Craig, I looked at the numbers, and there's certain line items, because essentially what you're doing is you're buying this property based on the numbers. The first thing you do is you drive the area. If the area looks good, then you get a financial pro forma, financial package. You look at the numbers, and then you determine what you would pay for it. And at that point, you submit an offer. You don't even look at the property contrary to
Most,
residential.
yeah, most of our buyers want to see the numbers before they go take the time to look
So
at
once
them.
you scrub the numbers, once you do your due diligence, say, all right, Pedro, I'm gonna pay $4.2 million for this deal. Let's write up a contract. You submit a contract, they accept, you go into good, you put your 3% good faith deposit, you go into escrow, now you're ready to play ball. Now you've got 45 days to figure out what's wrong with this
But
property.
what did we do all afternoon yesterday?
So we scrub the numbers.
We scrubbed the numbers, we wrote a letter to the listing agent based on buyer's input as well. We said we don't like this figure. They used forfeiture of security deposits. That's not consistent income you can count on. Used other income, it was probably late fees or whatever. That's not real revenue. On the expense side, they have really low insurance costs, those kind of things. So we got to the point where I think we were about 18 grand under the listing broker in terms of net operating income. Well, I broke out I itemized each item that we're making a change to with our offer. And, you know, if you look at it, if you have a 5% cap rate, for every dollar you have a difference in, that represents the reciprocal of that, which is 20 times. So, you know, 20 times, it was a 5% cap rate on this deal. So 20 times 18,000, what is that, 360,000 in value. So
That's how much he would have overpaid if we didn't, really hone in on the numbers. So it could really affect, the purchase price if you're not doing your due diligence, like one of the gentlemen up here was talking about.
And yet, benchmarks, rules of thumb, you can expect, for instance, per unit price, $4,500 to $6,000 per unit per year
Of expenses.
of expenses. Expense ratio, which is you take your revenue less any vacancies, you get to an effective gross income. You should be at or about 35, maybe up to 40%, depending on the property, expense ratio. So ranges where you need to be to get to that net operating income. And again, what's really made a lot of properties profitable to buy, and that's why we've seen such a fluid market now and so much money seeking few properties out there for sale. When you have 25 to 35% of your value that you're buying at a lower interest rate than the rate of return on the property, that's called positive leverage. You want to borrow as much as you possibly can, because you can even leverage off the bank's money to make that margin. Go ahead.
Do you also deal with commercial strip mall type properties, or is it mostly apartments?
Because of my education, because of my CCM education, my graduate degrees and everything, I got experience in education in all sectors. That's not our mainstay. Not saying we can't do it, and not saying we can't understand the fundamentals.
And do you have a sense of valuations in that commercial sector following the residential, or you think it might be a year or two behind as things start coming back?
You got problems in that sector. You got problems in retail and office because people need a roof over their head in apartments.
That creates the demand for our product.
Our economy's sucking wind a bit. So last thing they're going to do is take on a lease on a commercial property when they're at the margin. So you're seeing a lot of that. So I would recommend not going into those sectors. Maybe sometimes you can get really good returns off those because the risk is higher, but I would go with the slow, steady Eddie, and with rents rising, values are going to rise. That's almost a given.
And I don't see any for lease signs around here.
No. Well, they won't put, well, yeah, you don't see a lot of for lease signs, and they won't put, on average, I've got one client sitting here, I won't point him out, but on average, we won't put for sale signs on the property because it spooks the tenants. They think it's going to they're gonna raise the rent, the new buyer, but as long as you educate your tenants, then that kind of stuff doesn't occur, even though they may get raises over time.
Yeah, in this economy that the interest is so low for home buyers, why would they want to go in apartment? You can buy.
Because we got the same rate of interest.
No, the renters, I'm talking about renters, in my house.
Oh, why, oh, we are losing, that's called shadow inventory, we are losing some renters to home buying, but not, a lot of them, they still have a high threshold to try to become homeowners.
One of the frequent arguments I've heard about that question is it's very difficult to get a home loan these days. I've heard it's extremely difficult, not that I've been asking for one, but almost nearly impossible.
Yeah.
I've heard people that have impeccable credit scores, money in the banks, you know, that'll take, I don't know, 4 to 5 months to get approval
Yeah.
on a single family home loan.
And to be honest with you, it's been so right to buy a home lately with the interest rates down, costs down. If they haven't done it by now, you're only talking about trickles, I think. If they, you know, they should have probably bought their home by now, or they would have bought their home by now if they were going to buy one.
Go ahead.
So what is the motive behind this almost impossible to get a home loan then? I mean, like if they have great credit and they have the money and all of that, you know, there's always something going on behind the scenes, you know?
Yeah,
What's up with that?
banks are paranoid.
I think, I forget the saying, but I think they say that in a booming economy, loose policies are passed, and in a very
Tight
recession,
economy, yeah.
really tight laws are enforced, right? And I think that's what's going on. I think banks are super ultra conservative about lending money these days. They don't want to lose.
Well,
money.
they got spanked for their loose money policies, which is what got us into this mess in the first place. So
Well, there's loose and then there's insane.
well, yeah,
You know.
but that's why they're, you know, dotting all the i's, crossing all the t's. They will loan money, and they're getting more courageous about that. But they're still.
All right, thank you.
Do you have another?
And of course, the price of residential, I mean, a home in this market is so crazy, especially Santa Barbara. I mean,
Yeah.
$800,000 for a starter home. There's a lot of people that just can't even, will
Wow.
never be able to afford that.
How's this, Linda? You can buy a fourplex around here for say $1 million, right? And you've got 3 other tenants paying your mortgage. So a lot of people are doing that, especially people with wanting to enter the multifamily arena.
Great, is there any other questions? Now, just out of curiosity, apartment property management, you started it because you had so many apartments and you said, I might as well start managing for other people.
Yeah, because I have experience, I have the expertise in it. Why not get a fee, you know, talking more of a Machiavellian kind of aspect. You know, we're going to try to avoid our risks in our business and optimize on our returns. Well, brokerage is cyclical, and it's, you know, you only do so many deals, and with property management, it's steady Eddie, keeps your lights on. So, if that makes sense.
Oh, great, well, I have a property manager for my multifamily units in Hawthorne. I managed it myself for about 10 years, and then I got smart and said, why
Yes.
am I going to go through all these
It's
problems
labor
when it's
intensive,
only,
right?
you know, X amount of dollars for someone
Yes.
else to take it over? So, thank you,
Yes.
because
It's a cost
you
of
do
doing
such a great
business that,
service.
you know, even with management, you're probably talking 35 to 40% of your effective gross income. It's not killer. Pay the piper, allow yourself to have a life,
Yes.
and work your other job. Thanks for having me.